Have you ever watched a stock just take off and you're thinking, okay, where is it going to pull back before it goes again? Well, believe it or not, there's a tool for that. It's wrapped in a little bit of mathematical mystique, and traders use it to try and pinpoint those exact spots. So today we're going to demystify one of the most popular and maybe one of the most debated tools in finance, Fibonacci retracements.
I mean, that's the million-dollar question, right? After a huge price move, up or down, how on earth do you even start to guess where it might pause, catch its breath, and then continue on its way? That is the puzzle that technical analysts are constantly trying to solve. And that's where this tool, the Fibonacci retracement, comes into play. Just think of it like this. You're drawing a set of horizontal lines across your chart. These lines act like potential floors, what traders call support, and potential ceilings, or resistance. The whole idea is that after a big move, the price will often come back or retrace to one of these specific lines before taking off again in its original direction.
Okay, so we've got this tool, but how do we actually use it to spot these potential turning points? Well, you can't just slap it on any old chart and expect magic to happen. Nope. Its power, its whole effectiveness, really hinges on one very, very specific market condition. Getting this right is everything.
And here it is, the big one, the single most important rule. You only use this tool when the market is clearly trending, either going up or going down. Seriously, trying to use it in a messy, sideways market is just a recipe for confusion and a whole lot of bad signals. The entire point is to find a good entry point inside an existing trend. You're looking to buy on a little dip in an uptrend or maybe sell on a small rally in a downtrend.
So how do you actually do it? It's really just a simple three-step process. First, you got to confirm there's a real trend happening. Second, you pinpoint the start and end of that last big price move, what traders call the swing low and the swing high. And finally, you just connect those 2 points with the tool, and the software does all the heavy lifting for you.
All right, theory is one thing, but let's make this real. We're going to take those steps and apply them to a classic uptrend. This is where you get to see how those abstract lines on a chart can turn into some seriously powerful signposts in the real world.
Okay, check this out. Here's a daily chart of the Australian dollar versus the US dollar. You can see it's in a pretty clear uptrend, right? So to use our tool, we find the very bottom of that move, the swing low, and we click there. Then we just drag our cursor all the way up to the very peak of the move, the swing high, and click again. That's it. Simple as that. And as soon as you draw that line, bam, the software automatically plots these key percentage levels. Now you might be wondering, where did these numbers even come from? Well, they're all derived from the famous Fibonacci sequence. But what's really interesting is that 50% level. It's not actually a Fibonacci ratio at all, but so many traders use it as a key halfway point that it's basically become an honorary and super important part of the toolkit. And now for the moment of truth. Look what happened next. After hitting that swing high, the price started to fall. It pulled back, blew right past the 23.6% level, and came right down to the 38.2% line. And it's perfect. The price found support right there, it paused for a bit, and then it resumed that powerful upward move. If you were a trader looking for a place to get in, you would have had your eyes glued to that 38.2% level.
So, we've seen it work like a charm in an uptrend, but what about when the market's heading south? Well, the logic is exactly the same, you just flip it upside down. Let's see how these levels can act as a ceiling or resistance in a downtrend.
Okay, new chart. This is a downtrend in the euro versus the US dollar. The process is the same, just in reverse. This time, you find the swing high. You click there, and you drag your cursor all the way down to the most recent swing low. The tool plots the exact same levels, but now we're looking at them as potential resistance areas.
And again, let's see what happened. The price bounced off that low, it retraced upward, and it stalled out right around that 50% level we just talked about. That level became a ceiling. Sellers jumped in, stopped the rally in its tracks, and pushed the price right back down. For anyone trading that downtrend, that was a huge signal, a key area to think about placing sell orders. I mean, these examples look pretty convincing, right? But it makes you wonder, why does this work? Is there some kind of secret mathematical code that governs the markets? Well, the real answer might have a lot more to do with human psychology than cosmic numbers. This quote pretty much nails it. The whole idea is that the power of Fibonacci might not come from some magical property of the numbers themselves, but from a much simpler fact. A massive number of traders all believe in them. They all use them, and they all make decisions based on them. Just think about it for a second. If thousands, maybe millions of traders all around the world are staring at the same chart, drawing the same Fibonacci levels, and they all decide to place their buy orders at that 38.2% retracement, well, what happens? Their combined buying pressure can be enough to actually create the support and literally push the price up. It becomes a classic self-fulfilling prophecy.
And that brings us to what is easily the most important part of this whole thing. Because it's so easy to look at these picture-perfect examples and think you've found the holy grail of trading. But before you run off and start using this, it is absolutely crucial to understand its limits.
So let's be crystal clear. Fibonacci levels are not magic, they are not guaranteed turnaround points, and they are definitely not a foolproof strategy. What they are areas of interest. They're potential zones for support and resistance. Think of it less like a crystal ball and more like a map that highlights interesting places where a reaction could happen. It's just one tool in a very big toolbox.
And here's the reality check. Prices will often slice right through these levels like they're not even there. Look, if trading was as easy as just buying at the 38.2% level every single time, we'd all be millionaires by now. These are about probabilities, not certainties, and they absolutely can and do fail.
So we're left with this big question. Does the Fibonacci sequence reveal some kind of hidden order in the financial markets, or is its power just a reflection of our own collective beliefs playing out on a massive scale? The truth is, it's probably somewhere in the middle. But for you, the key isn't to solve that mystery. It's to understand that distinction, because that's what will allow you to use this fascinating tool wisely and not just blindly.